The first step to a successful exit strategy is determining how much your company is worth. This is best accomplished with an independent appraisal. An appraisal will help determine what options are available to you for the exit, as well as point out ways that you can improve the value of your business over time. Next, you need to identify your financial objectives. Engage with wealth planners, your CPA, and possibly an estate planning attorney to determine how much money you need to accomplish those objectives. Next, determine if your business is likely to attract a selling price that will position you to achieve those financial goals. This will help you determine a likely time frame for your exit. For example, if your business is already worth as much as you need in order to achieve those goals, then maybe your time frame is going to be relatively short. On the other hand, if you discover there's a large gap between the value of your business and the amount of money that you need in order to meet the goals of the next chapter of your life, then a longer time horizon may be appropriate. If in fact you find that there is a gap between the business's value and the amount of money that you need to achieve your goals, make a plan using what you've learned about your business in the appraisal process. A partner with expertise in value growth can be a very helpful resource. Finally, measure your progress towards your goal with periodic valuation updates to make sure that your plan is working. A question we're often asked is, how long in advance of a sale should you start planning your exit? In one case, we had a client that started working with us planning for an exit 10 years in advance of the sale. The business was worth $1 million at the start, and by the time the business was sold, it had attracted over $100 million in sale price. We helped them achieve this value by measuring the company's value, telling the owners which levers would maximize price over time, and then periodically updating those valuations to confirm that the business value was increasing the way that it needed to be. In another case, we had a client that wanted to sell in about a year. They'd received an offer from a private equity firm that seemed low to them. They wanted to find out if their instincts were correct, and they hired us to help. Our appraisal led us to determine that the price that was offered, while disappointing, was probably fair given the company's facts and circumstances. However, happily in our appraisal, we were able to highlight 3 things that could increase the value of that business. 1, their CEO was too involved in the business and couldn't get away. 2nd, they had a customer that accounted for over 40% of their annual sales, which created a significant risk in the eyes of most buyers. 3rd, they had minimal to no documentation of the key processes, making it difficult for a new owner to take over the company and sustain or build upon the company's existing success. Based on our recommendations, the client built processes that enabled the CEO to step back from the business. They managed to diversify their customer base, and they hired an expert to come in and document all of the company's significant processes. The same private equity fund returned after these problems were resolved and sent an offer that was 2.5 times that of the original. An interesting thing that we discover is that many business owners realize that after planning an exit, they don't want to sell because the company starts making more money and it's too fun to stay involved. In another case, we had a client in the tech space who wanted to sell because the owner was overworked. Our appraisal revealed that the business wasn't worth much, but could be worth a lot more. The issue was, in fact, that the owner was so heavily involved in the business, and the business was so dependent on him that it was taking away from the value of the business. With our help, the client learned how to delegate. His employees' capabilities grew as they learned from their mistakes. Ultimately, he decided not to sell because his workload was reduced significantly. He was making over $1 million a year, and he found that being the owner of a successful, profitable, and thriving business was a lot more fun. In this particular case and others like it, we're thrilled for the client even though they decided not to sell the business. The high score strategies model of independence ensures that our compensation is disconnected from whether or not the client sells the business. So you know you're going to be getting the best, most independent and objective advice possible. If you're thinking about the point when it might be time for you to step back from your business and reap the financial rewards from all that you've built over the years, contact High Score Strategies for a free consultation.